All right, Matt, stay right there. Let's bring in Warren Hogan right now, chief economist at ANZ. He joins us. He's in town and joins us around the desk here at the SGX. Warren, good to see you. What do you make of the RBA minutes? It sounds as though they're saying what we're doing right now is just fine. Inflation is cooperating. We have the room to move lower if we need.
Exactly right. Yeah, they've confirmed their shift in tone from the meeting with the minutes, and really the news for the RBA in the last couple of months has been domestically. They've got the green light from lower inflation. They've got the revisions to the past. We've got weaker numbers likely to come through in Q3. So that inflation risk is gone. And if they think they need to move for other reasons, i.e. world growth or domestic growth, then they can because the inflation story's improved.
Good to know, Matt.
Yeah, Warren, the market seems to be pricing in that we may see an interest rate cut on Melbourne Cup Day. Given what they've said in these minutes, how likely do you think that is? But we should also point out that they've said they're going to wait until their November meeting to obviously make a decision on this.
Yeah, well, the big news for them will be the Q3 CPI due out next Wednesday, and if that comes in where we think it will, and that's at 0.5 on the core numbers in the quarter, annualising out at 2%, then I think they are ready to go on Melbourne Cup Day. I think they've sent a strong signal. It's very rare that the Reserve Bank of Australia talks about rate cuts unless they're very close to doing it. They tend to prep the market, prep the broader community for rate hikes, but rate cuts, if they start talking about it, it's front of mind for them. So we get a low CPI, and I think that they'll go on November the 1st.
How closely do you think Glenn Stevens and the policymakers, the RBA, are watching what comes out of China with the data set today? We're expecting to see some moderation, but just at the margins. No fear right now of a hard landing, although is there reason for them to be a little bit more dovish on the basis of what is unfolding in China?
Look, the Chinese numbers, if they come out where we think or where the market thinks at around 9.2, 9.3 are good. And if anything, that would argue that, that the RBA's line that they've talked for some time is that Australia really is dependent on Asia, is dependent on China, rather than the US or Europe. And those numbers are pretty good. But it's actually not the numbers now that would be worrying the Reserve Bank. It's actually the effects of what's happening in the global banking system, in the European economy on growth for next year. And I think there's been enough of a shift in sentiment on the international scene for them to be worried about that, even if the Chinese numbers are good. So that combined with some weaker domestic numbers, I think a modest easing is in order. If China slows a lot, then we're not going to talk about 25 or 50 basis points of rate cuts from the Reserve Bank. We're going to be talking about a lot more. So I think these Chinese numbers aren't that important for what's going to happen in November for the Reserve Bank.
Let's talk very quickly about the slows a lot sort of scenario for China, although the numbers, if you're right, if the consensus is right, it looks as though they're on track to achieve a soft landing. But earlier this morning, we were talking about the problems in a place in the east of China called Wenzhou. And that not being localized, it being more representative of something that's sort of countrywide. That's going to mean a lot more attention, a lot more resources are going to have to be focused on China's own problems, its own domestic banking system, for that matter, the shadow banking system as well, no?
Look, there's two issues in China. One is that there is some uncertainty around how the shadow banking system is operating and what risks that poses to the Chinese economic outlook, and that's something we're all going to be watching very, very closely, just because that economy is so important to the whole region and the world. And the other one, of course, is that they don't have the same policy flexibility they had back in 2009 when Lehman's failed and they could do that big fiscal stimulus. Executing that fiscal stimulus has tied up a lot of the resources of their banking sector, of their local governments, and so another big fiscal stimulus of that magnitude isn't in order. That being said, the Chinese economy retains tremendous momentum. I think they're still as worried about inflation as they are about growth. We have to monitor the situation, but at this stage I don't think alarm bells in China should be ringing. I think it's a matter of managing a very rapidly growing large economy, and they're always going to have issues that pop up here and there in this sort of environment.
Okay, Warren, stay right there. We'll come back and talk more in just a bit. Warren Hogan, Chief Economist, ANZ. Questions for him, email us at squawk@cnbcasia.com. Back with our guest host, Warren Hogan, Chief Economist at ANZ, still around the desk with us here at the SGX. Warren, when we last talked, I think about 2 months ago, on the question of Europe, you're saying you were watching for a big-name financial to go under in Europe, one. And two, you thought that Europe needed a Europe-style sort of TARP program. 2 months on, how far have we moved on both issues?
Well, the European equivalent of a TARP is now progressing, the EFSF, and it's going to be a different form because it is a different set of circumstances, but I think that's progressing, and that's at the centre of the proposals here in Europe. In terms of a name event, the Europeans have to do everything they can to avoid that, and that was the risk factor. But I think what's happened in the last few months, indeed in the last few weeks, is that the market and the European policymakers realise now that this is as much, if not more so, a banking event as it is a sovereign event, and we have to focus in on getting those banks' balance sheets fixed up. The deleveraging we saw in the US, in the UK post Lehman's has not happened in Europe. If anything, many of the national banking systems there continue to grow. Yeah. You know, the lessons of the Lehman haven't been learned. So
do we know the full extent of the bad debt that these banks are holding?
No, well, I think that's one of the real issues, and one of the things the market hates, along with obviously being in the hands of policymakers in Europe, is the fact that we don't know exactly what the value of all these assets on the banks are, how much trouble there is behind these balance sheets. What we do know, of course, is the sovereign holdings, and you know, the different scenarios for restructuring of Greek and Portuguese and Irish debt and so forth, and what that'll cost the banks. But then it's more than just sovereign lending that's been a problem. These banks' balance sheets are too big. Certainly under Basel III, they do not have anywhere near the capital they're going to need, and I think there's big question marks in the market right now that their existing capital is not adequate for what they've got. So it's getting clarity and confidence back into the European banking sector, which I think is going to take some consolidation. We're starting to see that, as well as a recapitalisation.
Let's look ahead, if we could. End of this month, as well as very early next month, the EU, G20, they're doing summitteering, etc. Markets seem to have perhaps gotten a little bit ahead of themselves. Then overnight we had Wolfgang Schäuble managing expectations. Realistically, what can we expect to come out?
Look, I think the market doesn't need a macroeconomic solution to be laid out for the next year or two. The macroeconomic adjustment in Europe, particularly in the peripheral countries, will take a decade or more, and they need a recognition that there's a plan to do that. What the market needs is clarity on the banking situation, specifically the mechanism for recapitalisation. They need to be confident that the ring fencing of Italy and Spain will occur, and they need to know exactly what the restructure of the sovereign debt will be. So how much will Greece get in terms of a haircut, and it has to be substantial enough to be real, that Greece can get on and restructure its economy, freed of some of this debt burden, and move forward. So the market needs these sort of 3 or 4 components in a plan. And I think the reason we can say that is that there's this huge risk on, or this rally of the past 10 days has really been in anticipation that there is clarity now about what needs to be done. The solution and these problems will not be overcome in a matter of months. It will take years, but the market just needs a plan that has political support and a commitment, and also obviously a plan that's credible. I'd add one last point. The plan can't be about crunching these economies. If we get fiscal austerity plus the deleveraging of the European banking system, it's a monetary and a fiscal whammy onto these economies, which can spell disaster.
Recession?
Oh, recession for sure.
Yeah.
Maybe not for Germany, but certainly for Europe as a whole. Yeah. And of course, that kind of double whammy needs to be avoided. The macro adjustments have to be spread out over time. The fiscal austerity has to be spread out. It's the banking and restructuring of sovereign debt issues that need to be solved right now. That's what the market needs, in my opinion.
Excellent. Warren, pleasure talking to you. Very useful. Thanks for the ideas. We'll do it again soon. Drop by.
Thank you.
Okay, Warren Hogan, Chief Economist ANZ, around the desk with us here at the SGX.